If you've been following the silver market lately, you've probably noticed that something unusual is happening beneath the surface. While headlines continue to focus on daily price swings, a much more important story is unfolding behind the scenes. The real battle isn't about short-term price action, it's about physical silver, and right now that story begins in China. Welcome to Ag John Silver Update. Today we're connecting the dots between Shanghai, COMEX, industrial demand, and the growing supply pressures that many investors believe could shape silver's next major move. One of the strongest signals in any commodity market is when buyers are consistently willing to pay more than the global benchmark price just to secure physical supply. That's exactly what's been happening in Shanghai. For weeks, physical silver has continued trading at noticeable premiums over international prices. This isn't just another statistic. It tells us that demand for real metal is running ahead of available supply in one of the world's largest industrial consumers. Instead of focusing on today's exact silver price, which may change before you even finish watching this video, I encourage you to check your favorite pricing source like Kitco, TradingView, or the CME website. The exact number isn't the most important part. What truly matters is understanding why the market is moving and what forces are driving it. The story goes far beyond price charts. It connects China's physical buying, COMEX warehouse inventories, the booming demand from solar panels and electronics, shifting global investment trends, and several technical signals that experienced silver traders are watching very closely. Let's begin with Shanghai, because that's where much of the current momentum is coming from. China's two major precious metals exchanges, the Shanghai Futures Exchange and the Shanghai Gold Exchange, offer one of the clearest pictures of real physical demand. Manufacturers, refiners, investors, and traders all rely on these markets, making them an important indicator of what's happening inside the world's largest industrial economy. For much of 2024 and into the early part of 2025, silver premiums in Shanghai remained fairly stable. Prices generally moved in line with London and New York, but as spring progressed, something started to change. Chinese buyers began paying increasingly higher premiums above international prices, and those premiums didn't disappear after a few days. They continued to widen. That difference matters because premiums reflect real competition for available metal. A temporary premium can happen if shipments are delayed or local supply is briefly disrupted. But when higher premiums continue for weeks or even months, it usually signals something much bigger. It suggests that demand is consistently exceeding supply. For a country responsible for roughly 1/3 of global industrial silver consumption, that's a message the entire precious metals market pays attention to. China isn't buying silver simply for speculation. It's using enormous amounts of it to manufacture solar panels, electronics, electric vehicles, and other advanced technologies. When companies are willing to spend above global market prices just to secure physical silver, it sends a powerful signal that real industrial demand remains extremely strong, and that may only be the beginning of the story. Several powerful forces are working together to keep China's appetite for silver exceptionally strong. The biggest driver is the country's continued expansion in renewable energy. China remains the global leader in solar panel manufacturing, producing well over 80% of the world's supply. Every new solar project requires silver because of its unmatched electrical conductivity, making it one of the most important materials used inside photovoltaic cells. As China continues investing heavily in clean energy, the demand for silver naturally grows alongside it. Industry estimates suggest that solar manufacturing alone consumed roughly 200 million ounces of silver during 2024, and expectations for 2025 remain even stronger. With China sitting at the center of global solar production, it's no surprise that physical demand continues to rise. Import data tells a similar story. Month after month, large amounts of silver have been flowing into China from mining regions across the world, including Australia, South America, and precious metals vaults in London. This isn't random movement. It reflects a consistent effort to secure more physical supply. That growing demand creates an interesting opportunity for traders. Whenever Shanghai prices remain well above prices in Western markets, companies can purchase silver in London or even take delivery through COMEX, transport the metal to China, and sell it at a profit. This isn't simply money changing hands, it's actual silver bars leaving Western vaults and moving east, and that's exactly where COMEX enters the picture. For years, precious metals investors have closely watched COMEX inventory reports. Ever since the physical silver squeeze discussions began several years ago, warehouse numbers have become one of the market's most followed indicators. The difference today is what's driving those inventory changes. Unlike previous periods that were fueled largely by retail speculation, today's drawdowns appear to be supported by genuine industrial demand. Real manufacturers need real silver, and much of that demand is coming directly from Asia. COMEX organizes its stored silver into two categories. Registered silver is available to satisfy futures contract deliveries, while eligible silver meets exchange standards but hasn't been assigned for delivery. Understanding that distinction helps explain why traders focus so heavily on registered inventories. Throughout the first half of 2025, registered silver holdings have gradually moved lower. There hasn't been a dramatic collapse or sudden shortage. Instead, inventories have steadily declined week after week. It's the kind of slow trend that's easy to overlook on a daily basis but becomes much more significant when viewed over several months. Combined inventories have also trended lower compared with where they stood at the beginning of the year, continuing a pattern that has developed over recent years. Why does that matter? Because COMEX remains the heart of the global paper-silver market. Every day, futures contracts representing enormous amounts of silver are traded, far exceeding the quantity of physical metal actually changing hands. The system functions because market participants believe enough physical silver exists if delivery is requested. As available inventories gradually shrink, traders naturally begin paying closer attention. They're not expecting an immediate crisis, but they are watching how much registered silver exists compared to the growing number of outstanding futures contracts. That balance has become noticeably tighter than it was a year ago. It doesn't necessarily signal a shortage today. However, it does suggest that if physical delivery demand increases during a strong price rally, there is less room for error than before. Combined with Shanghai's persistent premiums and the steady movement of silver from west to east, many investors see these developments as strengthening the long-term bullish outlook for the silver market. What makes silver especially interesting is that it isn't just a precious metal. It plays two critical roles at the same time. Investors often think of it as a safe haven asset alongside gold, but that's only half the story. Silver is also one of the most important industrial metals in the modern economy, and that industrial demand continues to expand year after year. Unlike gold, which is primarily held by central banks, investors, and the jewelry industry, silver is consumed in manufacturing on a massive scale. Once it's built into products like solar panels, electronics, medical equipment, electric vehicles, and communication systems, much of it is no longer easily recoverable. That means industrial demand doesn't simply create trading activity, it permanently removes metal from the available supply. According to recent industry reports, global industrial silver consumption has reached record levels. Solar manufacturing alone accounts for an enormous share of total demand, and that trend continues to strengthen as countries accelerate their renewable energy goals. Governments across the United States, Europe, China, and many other regions are investing billions into clean energy projects, placing silver at the center of that transition. Although manufacturers have found ways to reduce the amount of silver used in each individual solar cell, the total number of panels being produced has grown so rapidly that overall silver consumption continues climbing. Newer technologies, including advanced photovoltaic designs, often require even greater amounts of silver to maximize efficiency. The demand story doesn't end there. Electric vehicles use considerably more silver than traditional gasoline-powered cars because of their complex electrical systems, charging components, sensors, and high-performance electronics. As EV production continues expanding around the world, every additional vehicle adds more demand for physical silver. At the same time, the rollout of 5G networks, artificial intelligence infrastructure, data centers, aerospace technology, military equipment, and advanced medical devices continues creating entirely new sources of silver consumption. These industries aren't driven by speculation. They require real metal to manufacture real products. While demand keeps increasing, supply hasn't been able to keep pace. Global mine production has remained relatively flat for several years, and recycled silver hasn't been enough to close the gap. As a result, the silver market has experienced multiple consecutive years where total demand exceeded total available supply. Those deficits don't disappear overnight. Instead, they gradually reduce above-ground inventories and tighten the physical market over time. Normally, when demand outpaces supply, higher prices encourage companies to produce more. Silver, however, doesn't follow that simple pattern. Around 70 to 75% of all newly mined silver is produced as a byproduct of mining other metals such as copper, zinc, lead, and gold. That means silver production depends largely on decisions made by miners focused on entirely different commodities. Even if silver prices rise significantly, global output cannot increase quickly because most producers aren't mining specifically for silver in the first place. Building new primary silver mines also takes many years. Environmental approvals, financing, infrastructure, and construction all require time, making it impossible for supply to respond immediately to growing demand. That long delay is one of the strongest reasons many analysts believe the current supply and demand imbalance could continue supporting silver over the coming years.